Good evening, everyone, and thank you so much for coming along to listen to our presentation tonight. It's an extraordinary world we live in today as investors. We have, in most of the developed world, zero interest rates, and in many parts, negative interest rates. There are $7 trillion today invested in securities around the world that are yielding their owners a negative return. So hand over your $100 and get back 99 or 99 and a half a year or two or three later. It's not a very attractive proposition to me, or I expect for most of you. How did we get here? Well, it's been a 30-year process, over 35 years of falling interest rates. If you look at the chart we've got up here, US interest rates peaked in the early 80s at around 15%. And it's been a pretty steady decline ever since, with the occasional up cycle, but nevertheless, each cycle it's got a little bit lower. And tonight I'm going to use mainly US data, but the story's pretty much the same wherever we look in the developed world. So what comes next is really the important question for all of us. And of course, in most people's minds, there's two simple possibilities. One is there are further falls. Now, and in doing so, into negative and substantially negative territory, perhaps. Now, I think it's been pretty clearly demonstrated and acknowledged by the central banks that this isn't a possibility. While institutional investors will accept a negative return on their money, you and I probably won't. So if our banks are going to offer us minus 1% on our term deposits, we're probably going to take that money out and do something with it. And that's what's happening in places like Japan. People are taking it out and sticking it in their safe. So there's a huge boom in selling home safes in those parts of the world where there are negative interest rates. But you also have other options that you might take up. Gold, which has always had a negative carry, all of a sudden perhaps comes a bit more attractive. Or if you're a bit more into 2015 options, maybe you take on Bitcoin. The other, and of course, if we are all going to take our money out of the banking systems, the central banks have a big problem. So they just can't pursue those sort of paths. The other option, and it's the one I suspect many of you are secretly hoping for, is that interest rates go back up, maybe to 5 or 7%. And usually, people who are, talk about this happening, it's normally the reason for it happening is just a return of inflation. Our view is that the most likely path is that we get neither of these things, but rather that interest rates are going to stay about where they are, around zero, for a lot longer to come. You may hear sort of economic commentators talk about lower for longer, but what we're talking about is potentially another 10 or 15 years of living with very low interest rates. I'm not saying that they won't go up ever. You quite likely will get a Fed rate hike in the US at some point, but we just don't see them going back to 5 or 6% anytime soon. And what I'm going to do today or tonight is take you through why we believe that's the case, but more importantly, what we as investors can do and how we might prosper in such a period. Before I move to that, I just want you to think about the last 30 years and what lower interest rates have brought us. Really, what we have seen now since the early 80s is a series of rolling investment booms followed by crises. So if you go back to the 1980s, those of us who can remember it, which includes me these days, I can just hit some fairly significant birthdays of late, but Japan in the 80s was the great boom. It was the property market. And the property, if you will recall these sort of stories, at the Imperial Palace in the centre of Tokyo was worth more than all of California. And we know how that property market ended. Property prices remain a long way below those levels today. Then we had, for a brief time, a great bull market in global shares in the mid-80s that finished with the 87 share market crash. This is very exciting. We had one of the biggest price moves in global shares in a two-day period ever. But today no one really remembers that. That is a sort of a footnote in share market and economic history because nothing really came of it. But it was very, I remember at the time having just secured a job working at Bankers Trust with Care. It was a pretty exciting few weeks. Then we go into the mid-80s, we had the Asian investment boom. And of course, that all came to an end with the Asian crisis, the Russian bond crisis. LTCM was a hedge fund that the Fed had to essentially step in and help bail out. From there, we went to the tech stock bull market. And this is one of my favourite ones to remember because if you go back to 2000 and you recall the things that we were talking about as far as, the promise of technology, our mobile phones were going to be connected to the internet. We're going to get all sorts of interesting information on them. We may even be able to transact on them. If you think about the stories we told back then, or the predictions of the future, they have been far surpassed. And yet, if in 2000 you owned the 4 big stocks that everyone owned for the tech boom, Microsoft, Oracle, Cisco, EMC, you'd still be losing 50 to 80% of your money. So everything that those companies promised they'd do, they did, but you still lost money, which is an interesting thing to remember when we get to the later in the presentation. Quickly, we then go into the housing construction boom in the US, the rest of Europe. That ends with the GFC. China then, construction boom continued on, creating a global resources boom that we all experienced here. That's obviously come to an end now as well. But we keep having these booms. So then the last 3 years has been biotech. $40 billion raised in the US in that period to invest in biotech stocks. And again, that looks pretty much like it's over now. But there's one last boom going on that I can identify. It's happening right now. It's happening in this country, and that is the construction of apartments. So if you look at it, for a couple of decades, we've built 40 to 50,000 apartments in Australia each and every year. Last year, it's moved up to 70,000. It looks like it'll be 90,000 or more this year, and and perhaps going beyond that based on new projects and approvals coming through. But I want you to stop and think about that number, because if you look at Australian housing starts in aggregate, so the housing and these apartments, and you adjust for the population, so we've got 24 million people, China 1.4 billion, population adjusted, it's 12.5 million housing starts. Now, interestingly, this is the exact number that causes everyone a great deal of concern about China having built too much housing. And yet China, 15 years ago, had no modern housing stock. It's experienced a massive rural-to-urban migration. And I think there's a whole lot bigger chance that they actually need that housing than perhaps we do in terms of what we're building. But why focus on all of this to get more onto the future than the past? Well, it's simply this. We have to consider the legacy of what this period has left us with, of ongoing falling interest rates. And the first of these is it's left us around the world with a high degree of indebtedness, whether that's households, companies, or governments. And what this means is the sensitivity to interest rate rises is much greater than it once was. So we don't think rates can go up a very long way, simply because as we put up rates, the impact on people who owe money is going to be much faster. It'll be much and greater. And to get a just sense of how much this worries markets, you can see that the panic we had in January, February, after the Fed put up rates for the first time in 9 years, in December. This period of all these rolling investment booms has also left us with excess capacity in a wide range of industries, whether that's too many apartments or homes in Europe, too much steel capacity in China. They built 1.2 billion tonnes of steel capacity. They need about 700 million, and you'll see the ongoing headlines about the need for much of that, or significant closures. But what that does is two things. One, we've exhausted a huge number of investment opportunities. They're not going to come again. And it also suppresses prices because there is this excess of pretty much any manufactured good you might like to have. The third reason is the way we all are reacting to this as consumers. If you go back to high school economics, what are we meant to do when interest rates fall as an individual? Well, we're no longer being incentivised to save, so we should go and spend that money. We should consume more. Well, the consumer isn't playing the game that the central banks would like. And if you think about it and consider a middle-aged family saving for retirement when you're faced with zero interest rates, first of all, you've got to save a lot more. By the time you get to retirement, you need a much bigger pot of money to support your lifestyle when you get there if rates are going to be low. And secondly, it's a whole lot harder to get there because you're not getting a decent return on your money as you progress. Now, you might say, but you've got the benefit of very low mortgage rates when you're buying your house. And they do, but unfortunately, because housing prices have gone up everywhere, they're paying a lot more for their home relative to their income, offsetting a lot of that gain. So I don't think consumers are being so foolish in refusing to spend up in the way that central banks and governments would like them to do. It's a perfectly rational response. So where are we going to go wrong with this idea that interest rates stay subdued for a long time? Well, the key one will be inflation. This is what everyone is waiting for years. And if you think about it, if you go back to my series of booms and busts and ever lower falling interest rates, what's happened to inflation during this period? Well, on this chart you'll see on the blue line, inflation fell very quickly in the early 80s, but it really hasn't done a lot since then. It's basically bounced around 2% to 4%, more or less, a little bit lower lately. But I'm not sure why we keep expecting lower interest rates to bring us more inflation. It hasn't done it for 30 years. The other thing I think people aren't good at accepting the fact that central banks can actually set interest rates. They set them at the short end of the curve, so 180-day money. But if you talked a few years ago, they said, they can't really impact the bond market. Well, quantitative easing comes along, they just go and buy the bonds. Central banks are setting the interest rate at every part of that maturity curve from 0 out to 10 years and beyond. And if you think about it and you look at this chart, you can see that interest rates are well below inflation in the US, as they are in many parts of the world. So you're actually getting negative real rates, but we still have them because the central banks can set them. But other reasons inflation has been pretty hard to find. If you think about how in that 30-year period we have opened up trade to the developing world. So in that period we've seen trade start with Southeast Asia, Mexico, China, India, Eastern Europe. We have brought billions of people into the global labour force. And it's simply suppressed the wages of people who are competing with them. If you look at the US, the bottom 20% of households in the US by income have seen no increase. In fact, they've seen a fall in their real household income in that period. The next 20%, so if you look at the bottom 40%, have barely seen an increase. So it's pretty tough down there. The top 20% have done pretty well, but it's a select group. Technology. In 1980, we did have a mobile phone service in Japan. Started in 79. In 83, it was the first mobile phone network in the US. The PC, the IBM PC at least, 1981. The internet, of course, was something most of us didn't come across until the mid-90s at the earliest. These technologies have provided massive improvements in productivity, and again, this has driven down pricing of most manufactured goods. We can't see these two factors going away really anytime soon, but there is one key risk to this idea that inflation stays where it is, and something I think we should all be thinking about and aware of. One of the other reasons inflation came down, particularly in that early 80s period, was that governments started to cut back on their spending. And it may have been a relative thing, but relative to their enthusiasm for spending our money that they had in the 70s and early 80s, they started to develop some fiscal discipline as such. And that's still very much part of the political discussion here in Australia and everywhere today about how governments need to be responsible with their spending and taxing. But here is the problem governments face today. Their one policy for getting the economy going again has been interest rates, and they have nowhere to go with that, and it is not working. How long will it be before they look to the only other mechanism they have, which is fiscal, is the budget? So we think we will start to see governments wanting to spend money more and more, though it probably will take some time before they develop enough enthusiasm to impact inflation. So to summarise these factors about why we think we remain in a world of suppressed interest rates, it's high level of debt, too much capacity in just about any manufactured good that you can think of, household savings, the response to save rather than to consume to these low rates. Labour cost differentials in the developing world are still favouring suppression of wages in the rest of the world. And of course, technology development is ongoing. If you think about what Uber is doing to taxi fares or Airbnb to the price of a hotel room in Paris or New York. So one final point on this matter I'd like to make. And this draws on the work of Jonathan Wilmot, who's the chief economist at Credit Suisse. He identifies two periods of very similar, with similar characteristics, mainly being that there's a lot of debt in the global economy, there are weak banks, and growth is generally pretty sluggish. And that was the 1890s, or the crisis, or the downturn that came after the 1890s, and the 1930s. And after both those periods, all those peaks and the booms back then, interest rates, as you can see on this chart, actually took 25 years until they started to substantially move back up. So we're 8 years into it. If that's the roadmap, we've got another 17 to go. Now, I don't want you to think that we think that this is just like the 1890s or just like the 1930s, because it's not. The world economy is structured very differently. The types of policy mechanisms that governments use are very different. But all I want to say is that it is not without economic precedent to have such a period of suppressed interest rates. So what are we to do as investors? How are we going to prosper in such a period? Well, there is one more recent period we can look at in history to give us a bit of a case study on what the rules might be, and that is Japan. So Japan, again, high debt, weak banks, low growth. That's been the situation there since the peak in their markets in 1990. And of course, it's been a terrible stock market to be in Japan over that 25 years. But if we look at our Japan fund, which we launched in June 98, so 8 years into that downturn, since then the market has made you 1.5% per annum. Not that exciting. But our fund has returned 14.6% over that period. So turning $20,000 into a little over $225,000 in that subsequent 18 years. So the question is, what were the lessons that we learned investing there over that period, and how are we applying that today? Well, I'm going to stop here and I'm going to hand over to Clay to take you through just that. Thank you very much.
So good evening, everyone. So my presentation today tries to answer that question. If we indeed have this scenario of a prolonged period of low rates, what type of stocks should we own, and how can we make money in markets? But firstly, we invest in equities, so why are we dwelling on interest rates in the first place? And there's a few reasons. So first of all, don't underestimate the effect that low rates can have on investor behaviour. So for the millions of people saving for retirement, having a large amount of your funds sitting in fixed income, earning 1% is something people are not going to accept. And secondly, it's probably not something they can even afford to do longer term. So we do need to keep in mind that people may invest differently to what we've experienced in the past. Secondly, interest rates are absolutely key in setting valuations. So it begs the question, when the risk-free rate is 0, what's the right price for a stock then? We can look at history. So over the last 50 years, the risk-free rate has tended to be around 4 or 5%. And over that same period, the average PE for stocks has been 15 times earnings. But when the risk-free rate is 0 or it's 1%, is the right PE still 15? Again, it's something we need to keep an open mind about. And finally, I do think we need to pay attention to this recent phenomena of negative interest rates, simply because we are in uncharted territory here. 2 years ago, negative interest rates simply did not exist. And now we have two of the world's largest economies in Japan and Europe, both operating under a negative rate scenario. This was unthinkable, and the rules of the game are still very much being learned. So, given we're in uncharted territory, what insight can we provide? And as Andrew has just introduced, we think Japan is that recent interesting case example of where rates have now been below 1% for over 20 years. So what I'll do is take you through 3 observations of what worked in Japan over that period and how we're applying those lessons to our portfolio today. So the first observation was around growth and growth stocks. Now, Japanese investors became extremely enthusiastic for stocks that could grow, and they would often bid these companies up to very high valuations. And the first question, well, why did that happen? And it came down to this issue of scarcity. So you had low rates in Japan because the economic picture was fairly bleak, the economy was slow. And with that backdrop, the number of companies that could then grow at a decent rate each year just became fewer and fewer. And like anything that becomes scarce, investors then naturally feel more comfortable paying up for it. So is this a prescription to go off and buy growth stocks at any price? And when you look at the back testing and you actually test this strategy, the answer is absolutely not. The returns were quite poor, and it was because you always ended up overpaying for these businesses. But when you go back through and look at all the data, there was a sweet spot. So if you paid a reasonable multiple for your growth stocks in Japan, and in Japan that magic number tended to be around 20 times PE or less, you actually did very well, and you often caught many of these vast re-ratings. So an example of growth, of how we're approaching growth or a growth stock in our portfolio today is PayPal. Now, most in the audience may recognise PayPal as a payment method you would use to purchase something on eBay. But from that beginning, PayPal has now expanded, outside of eBay, and it's become one of the most popular ways to now pay for anything online. And to give you a sense of how mainstream PayPal as a payment tool has now become, the company now has 170 million active user accounts, and they're adding 1 million users every 30 days. So the growth's truly incredible. Now, to put that in context, American Express, payment method we're probably would all recognise in the room, they've got 110 million card holders globally. So it's not going to be long before PayPal has double the user base of an Amex. And once payment methods reach mass adoption, they truly become fantastic businesses. So for every $100 you spend using PayPal, the company captures about $3 in revenue and keeps 50 cents in profit. And when you consider that PayPal last year processed $280 billion in transaction volume, you quickly see that the profit pool is truly enormous. So here we have a great business that's growing at a rate of about 20% per annum, and we were able to build our position in PayPal at that valuation sweet spot at 20 times earnings. Now that sounds all well and nice, but the question always has to be, well, why is the market giving us this opportunity? And the fear the market has over PayPal is around competition. I'm sure you may have read in the papers, lots of articles and hype around fintech and all these new competitors rushing into the market, setting up competing payment tools. And we're less worried about competition simply because history has shown you time and time again, getting a payment tool to mass adoption is incredibly difficult. The reality is our existing payment methods work very well, and to get millions of consumers and merchants to go to the trouble of accepting something new, you really do need a unique set of circumstances to arise. The moons really do need to align. And you may be thinking, well, if it's so hard, how did PayPal do it? Now, the genesis of PayPal was solving some of the new problems that came about with the emergence of online shopping back in the early days. So I want you to cast your mind back to the year 2000 and you're buying yourself a digital camera on eBay. Now, if you didn't use PayPal, you would have to give your credit card details to someone you did not know over this fairly new thing called the internet back then. And for many people back then, that simply did not feel safe. The second problem was, well, this fellow is now going to post you your camera. And what happens if he doesn't put it in the post? Or it arrives and it's broken, or it's different? Who do you turn to? Who's going to help you in that situation? And finally, from the seller's perspective, back then, getting set up online to accept credit cards was both expensive and reasonably difficult. And PayPal walked in and they really solved these problems. So if you used it, the merchant saw none of your credit card details. It hid your financial details. PayPal had this fantastic buyer dispute protection program that gave people comfort that if there was a problem, they had someone to turn to. And finally, as a seller, you got a PayPal account and suddenly you had a quick and easy way to accept payments online. And these were the unique seeds back then that allowed this payment tool to take off. And we just don't see the same confluence of factors that is going to help the new competitors today. So the simple growth story around PayPal is if you believe online retail is going to grow, that we're going to shift more of our spending dollars online, then it's highly likely that PayPal is going to take their fair share and be a considerably larger business in 5 years' time. So the second observation of what worked in Japan was dividend yields. And this made logical sense. So as an investor, you could no longer get a decent yield from the bank or via owning bonds. So stocks that paid a nice dividend yield became very sought after. And maybe the surprise is just how well the strategy of owning dividend-paying stocks did. So again, we've done some backtesting. We've got Credit Suisse, a third party, to do this backtesting for us. And we took a universe of Japan's 500 largest companies and a strategy of owning the 100 stocks in that universe that paid the highest dividend yields in their respective sectors. Following that strategy, saw your investment go up 5-fold over that 18-year period versus just over a double had you owned that universe, that market as a whole. An extremely attractive return. So one of the ways we're approaching dividend yields in the portfolio today is the European banks. We own a selection of European banks. The case around each one is slightly different. However, in the chart, I show you the yield on offer from two, and that's Intesa Sanpaolo in Italy and Lloyds Bank of the UK. And what we've done is shown you, firstly, the best advertised one-year term deposit we can find in each country. And alongside that, we show you the dividend yield that the bank paid last year and the expected yield they're going to pay this year. And I think you'll agree that earning 7 or 8% yield is fairly interesting versus a 1% term deposit. So again, why is the market not snapping up this opportunity? Well, investors still harbour a lot of fears around the banks. It's understandable given what they've just experienced. So Europe's really only just emerged from a 5-year recession. Over that period, both Intesa and Lloyds had to write off about 10% of their entire loan book in customer defaults. Regulation around the banks became more stringent over that period. They were forced to hold more capital. And finally, the banks became political targets. We saw the introduction of special bank taxes and other measures. And none of that was particularly comfortable for shareholders over that period. And after all of that, the worries are still not over. We have questions like, well, what happens to the banks if the UK leaves the euro? And now we have this issue of negative rates and what effect that will have on banks' profitability. However, each of these worries has merit, but if we bring it back to the fundamentals, we know the leading banks in Europe have gotten stronger. So in the UK, we saw the market consolidate down to 4 major banks, very similar to our home market. And in Italy, there's a wave of banking consolidation going on as we speak. The competitive landscape in banking is very important, and it has undoubtedly gotten better in Europe. Secondly, the banks are now considerably safer. Now, you may have seen that this year the Australian banks had to come out and raise more capital in the market. Well, for these banks, that's now been done. That's behind us. They've built very large capital buffers. In addition, these banks have now been battle tested. The loan books of these banks have been battle tested after 5 years of recession. The weak borrowers that were going to default have done so. So it's a very nice starting position. Thirdly, the banks are now seeing a positive inflection in their business trends, and this is happening now. So loan growth, while it's still modest, has come back, and the loan book is now growing at 2 to 3%. House prices in these countries, after a good fall, are now rising again and rising sharply in many of these countries. And importantly, the cost of customers defaulting is now falling away very fast. And what this really means is the banks are now starting to make decent profits again. And boiling this all down, what it comes down to is that we think these yields are now sustainable. And even if the share prices go nowhere from here, you're going to be earning an 8% starting return. Given the long-term returns from share markets over the last 50 years has been about 7 or 8%, that's a fairly nice starting point to make money. And the Japanese experience showed you that once people become a bit more comfortable around the stories around the banks, they won't stay at 8% yields for too long. So the final observation of what worked in Japan is what we would say is maintaining a contrarian view and paying attention to value. So in Japan, because you had little growth in the economy and interest rates have already been cut close to zero, there was this sense that the place was far more vulnerable to shocks. The policymakers had used up all their bullets, so to say. So when problems did arise, whether it be at a company level or a macro level, you would often see these wild swings in investor sentiment. So investors would get very pessimistic. However, when sentiment got bad and valuations got cheap, the lesson was to go after them. And if you did that consistently in Japan, you made very good money. Value as a factor really worked in Japan. And again, we can show you this via the backtesting. We take the same universe of Japan's 500 largest companies, a strategy of buying the 100 companies that were priced cheapest on a price-to-book measure in their respective sectors, saw your investment go up 4-fold over that 18 years. So slightly less than the dividend yield example, but still that's a compound annual return of just over 9%. Certainly not a bad outcome. And in our portfolio today, PICC of China is a good example where sentiment is very poor, but valuations are excellent. Now, PICC is the leading property and casualty insurer in China, and 80% of their business is selling simple auto insurance to consumers, with the other 20% insuring other lines like commercial property or health insurance. Now, investors are reluctant to own this stock because of the general worries around the Chinese economy. Secondly, they're worried that interest rates in China may fall further. And this would see PICC earn less on its float or its pool of premiums that it takes in each year. And finally, they're worried that PICC may be called on to do some form of national service, whether that's supporting the equity market or the banks. But again, if we look past these short-term worries and focus on the fundamentals, the future for PICC looks very bright. So the company is growing at 15% per annum currently, and we think it's fairly likely that it can continue at this rate for some time to come. Why? Well, first of all, PICC makes money insuring cars. The more cars on the road, the better. Now, the modern car fleet in China is approximately 120 million vehicles today. That works out to be roughly 9 cars per 100 head of population. And we can look at how this measure compares in other neighbouring countries. So in South Korea, that number is 45 per 100 head of population. And in Taiwan, it's 32 cars. So from a starting point of 9, it's not hard to see the Chinese car fleet at least doubling from here. Another nice factor is other insurance lines that we're very kind of familiar here with in the West. Home and contents, health insurance. These lines are nascent in China, but they're now starting to grow very fast. So to give you some context, non-auto insurance in most markets in the West, or even many emerging markets, typically accounts for 60% of total industry premiums. But in China, those lines only account for 20% of total industry premiums. So again, from that base, it's not hard to see these lines double or triple again over time. So overall, we're paying 9 times earnings for PICC today. That's a 30% discount to Western insurers that typically trade on about 12 times earnings. But the big difference is those Western insurers typically are seeing 0 growth in their underlying business. And we think this is a very attractive investment opportunity. It's a long duration investment, and it's one that people will come back to as the fears around China recede. So just to recap, in Japan, growth did work, but you needed to be sensible about the price you were willing to pay. Dividend yields worked fantastically well, and again, paying attention to value, taking a contrarian approach did see you make good money in that market. So I'd like to thank you all for listening, and I'm going to invite Andrew back onto the stage. Thank you.
So what I'd like to do now is very quickly take you through where we see the opportunities in global markets, where we might make some money in the years to come. And so to just start with the obvious, and that is we don't think bonds and fixed interest, so your bank deposits, are going to be, we think you are going to get very low or 0 returns. And indeed, when we go back to that issue that, inflation is well ahead of them, you're going to get negative real returns. Now, Australia is different. We're still getting a very generous 3% on our term deposits, or 2.5% from government bonds. But it's not clear to me that you will continue to get that for a whole lot longer. We think Australia still has some adjustments to make, and I'll talk about that a little bit later on, but we think that the message is just as applicable for Australian investors as anywhere else. So how are we going to make some money? Well, it leaves us with 2 areas, I guess, shares and property, and I won't talk about property. Shares are obviously our area of expertise. And I understand, there's a general sense that we have from individual investors that there is a reluctance to really get involved in the share market at the moment. And we think that's actually fair enough. If you look at global markets outside of Australia, they've been very strong for quite a while. The valuations in many of them are on face value very high. So in many sense, that caution is well placed. But what I'd like to do is remind you about our approach to investing in share markets. And you may have seen this slide if you've been to any of our presentations in the last 20-odd years. Our approach is to look for opportunities in that part of the market that is unloved or out of favour. That's where we think you'll make money. And what you need to do is avoid those areas that everyone else is comfortable being in. if you think back to my comments about the tech bull market, that was what you needed to avoid. You needed to avoid those technology stocks. Today, actually, they're not that bad. I'll come to them a bit later on as well. But to talk about where our investments are in the international fund and where they differ from what you might find in any other global fund that you may have or that is on offer, two key differences. The first is that in the US market, we have around 20% of the fund invested there. Now, you'll see from this slide that most other funds have around at least 50% and potentially as high as 60% of their money invested in the US. For us, the US is clearly the least attractive market of all. It is the market where everyone is comfortable. Its economy has recovered the best since 2008. Employment is strong, wages are starting to move up. Profits have been pretty good. The banking system is also very sound. This is the easy place to invest. It is loved. The problem, and I should say, it's not without opportunities. We do find stocks in the US individually or in the area of growth, as Clay was saying. We own PayPal. We also think Google has been held back by various concerns over the years and remains an interesting investment that's growing very quickly. We own some of those tech names that were famous from years ago, Oracle, Cisco, businesses that are still growing, albeit slowly, but at very attractive earnings multiples on around 12 to 15. We own some individual companies that are well-known names to all of us, but are actually going through quiet revolutions in their business. One of them is McDonald's, the other is Coca-Cola. We think these companies can make us some pretty good returns in the next few years. But broadly, it is not easy to find stocks that you want to own in the US. And in aggregate, what we look to is the valuation of the whole market. Now, what this chart shows is the PE of the US market, and it's the so-called cyclically adjusted PE. So it actually averages profits over a long period of time to get out up and down cycles. And what it is simply showing is that today, based on average profits of the last 10 years, it's on 26 times. And as you can see, there have been very few moments in history where it's been above that level, and when it has, it's been the time to get out. Indeed, if you look at it, history will tell you if you buy the US market at this type of valuation, the return you can expect over the next 10 years is around 2% per annum. Not a whole lot better than you're getting out of your US bonds and cash. So there's one other place in the world where we have a very different position in our portfolio to pretty much anyone else, and that is China, where we have around 18% of the fund invested. Now, China is not everyone's favourite market at the moment. There are very obvious problems. You only need to look at the front page of the Fin Review most days. There has been a massive investment boom. There is too much steel capacity, aluminium capacity, cement capacity, you name it. They've built too much of it. The banking system is seeing a big pickup in bad debts, and we expect that will go on for some time to come. Our view is that at least 10% of banking assets will turn bad in that country, and we're only at 2.5 or so at the moment. But the stock market is down 50% from its highs of 9 years ago. And it is a country that has many policy options available to it. The government has not cut interest rates aggressively yet. It has not freed up the banking system to lend. It is only just starting to spend fiscally on infrastructure projects which are much in need. It is not a case that they are building roads to nowhere, as some people will tell you. So there's many reasons to be positive about China besides this, though. Areas like the internet, e-commerce is booming. Insurance and motor vehicles, the consumer. So if you look at our portfolio, we are not buying China Incorporated. We do not own steel stocks. We do not own cement stocks. You'll have heard from us before about our internet companies, Baidu. It is the Google of China. Its business is growing 30% or so per annum. Tencent, the so-called Facebook of China, although without giving you a 20-minute lecture on it, it is so much more than what Facebook is to the Chinese consumer, and it's also growing in that 30 to 40% region. Consumer names such as Mutai or Younghe Brewery, they make the white spirits. You wouldn't be able to go through an airport these days internationally without seeing the Mutai stacked up everywhere for Chinese tourists. These are highly profitable consumer companies that will grow. They have dividend yields, and you're buying them on mid-teen multiples, or a little bit higher now because the stocks have been performing well. So we think this is a great opportunity to buy some high-quality companies. They have clean balance sheets, they're profitable, and they're growing. Elsewhere in the world, Japan remains the cheap stock market. Our focus here is really finding companies that are looking to improve their profitability. The long-term problem in Japan is companies with great market positions but no profits to show for it. And after 20 years, many companies are now turning and focusing inward on how they can actually make money. These are the interesting stocks for us there. In Europe, it's the banks, as Clay's already taken you through, and also the drug companies, where have been for some time, but they remain on interesting valuations. There are various concerns about, pricing of drugs, problems with their pipelines in terms of new drugs coming through, but we actually think this remains a very prospective area. One final comment to make on the portfolio, and that's with regards to the Australian dollar. Now, in the short term, it's obviously had a nice run up from 70 odd against the US dollar to 77 recently, a little lower today. And we took on some Aussie dollars into the portfolio. We hedged about 15% back in, because in the short term, this economy is not doing so badly, in spite of whatever the inflation numbers tell you. It's doing reasonably well, and there is that interest rate differential. People are getting paid to own Australian dollars, so international money does look to buy our currency because you do get a return. And that is going to support the Aussie dollar. But there are two things that we look to that much longer term, give us concern for the Australian dollar and why we think ultimately interest rates here will go lower. One is, if you look at the investment that has gone into the mining sector and the resources sector, it was a great boom, started at less than 1% of GDP, has gone up to 6 or 7, is now down around 4% of GDP. But it will return to the lower levels. At the moment, we have big projects. There's still investment going in, particularly in the gas area, gas fields in the north. That is providing some support to the economy still. That will dissipate. The other thing is the construction of the apartments that I mentioned earlier. I'm not telling you that that boom's going to end this year or next. It could go on for quite some time, given the amount of Chinese money that is out there chasing investments around the world. But it will, like all those other booms, come to an end, and with it you will remove one of the last supports that are helping this economy stay strong relative to the rest of the world. And at that point, we think that the Australian dollar will potentially go quite a lot lower than from where it's been recently. So I'll finish at that point. I'm going to invite Care up to make a few brief comments before we move to Q&A. Thank you very much for your attention.
Good evening, and thank you all for coming this evening. It's wonderful to see so many familiar faces. We asked you to kindly fill in this questionnaire, which was to reveal different things. So firstly, we gave one set of questions that were seeking out those responses to people's fears, and then there was another set of questions which was directed at those who took who were given choices that were sort of opportunistic or optimistic. And so let's look at the outcome. So Harthroom was asked about their fears, and the fears were a Chinese slowdown, deflation and negative interest rates, and a sort of debt-driven GFC event. The other half were asked about the opportunities, and their top selection was healthcare, agriculture, and Chinese consumer stocks. But there's an experiment here because, as you know from our whole approach to investing, there's a whole lot of psychology, and the psychology here was if you frame something in a negative way, you might get one response, and if you frame it in a positive way, you'll get another. And what we actually found was true to that. So those who were given the fear-loaded questionnaire, they suggest the market will be up by about 3.3% by the end of this year. That is the general markets. And those who were asked to look at opportunities, they were more optimistic, and they came in at 5.3. So it sort of works. It didn't work in Brisbane, I should tell you. So it is very interesting, the focus, and these are the sort of stuff that we're seeing in the headlines, and that's the really interesting thing, because we can show you a chart here that really shows you the sort of fears we've had to live with in relatively short time. Never mind Andrew's 1980 onwards syndrome. We've had plenty of concerns that have come through in this very short period of a year and a half or two. So we are in very unusual circumstances. We are in uncharted water, and we think it is highly likely that rates stay low. So just to reiterate that. But think of the problems that brings, because you are forced to do things you don't particularly want, and there'll be lots of anxiety because of concerns about the future and just uncertainty. It's very well researched. Uncertainty leads to markets being volatile, but also tending to be weaker. There's the whole question of cheap money, I think, will create volatility in markets as people run from pillar to post trying to understand what's really going on here. I do think that we will have low price increases, so-called low inflation, and we must think about Japan because, as Andrew pointed out, we've had a period of sloth of over 20 years. But importantly, I should tell you that even in that period, you have had growth of about 1% per capita in Japan over that 20 years. So each year you've had, not each year, but in compounding, you've had about 1% growth, compound per annum. So it's not as if Japan hasn't grown, and yet it has thrown up those opportunities we showed you. And that's really the message for tonight. We have experienced this type of environment before. Why shouldn't we make you some money in it is really the key takeaway. Now, what is really interesting is we look at the world. The index is made up of over 50% in the US, and it's priced on standard earnings, never mind those cycle-adjusted earnings, at about 21 times. Historically, it's been about 15 or 16, so it's quite well priced. It's quite enthusiastically priced. And the remarkable thing today I read was that the last of the 3 AAA-rated companies has been reduced to 2. So in the 1980s, there were about 60 companies that had AAA ratings among listed stocks in the US. It's diminished to 2. The remaining 2 companies are Johnson & Johnson and Microsoft. The one that dropped out last night was Exxon. It had had a AAA rating since the 1930s. So in a world where there is a clear deterioration in the quality of companies, we have a market that is priced very highly. Very, very highly. And yet, no one's particularly keen on the emerging markets, even though it is probable they will grow faster than the developed markets. That doesn't guarantee profits will grow, but in fact, profits have been quite suppressed in many of those markets, and we can see reason why they could improve. So really think about what your alternatives are. We think it is imperative that you remain invested in shares. We, as you know, our only interest is in international shares, but we do think it gives you the opportunities of these developing countries, of these developing industries. It gives you diversity, and we remain absolutely committed to the view that over time this will prove to be profitable for you as investors. So what I'd like to do is ask Andrew and Clay to come up, and then we can delve into anything that's really troubling you. We prefer the things that are troubling you, so we get them on the table. And do ask us any questions you like, embarrassing or not.
And that would be great. Thanks.
Thanks for the presentation. You mentioned in Chinese companies, and you're saying with clean balance sheets and so on, but how easy is it to research those companies so you really understand what their balance sheet looks like?
So I guess that, the question about Chinese balance sheets and how easy is it to actually establish that, and this is always one of the key concerns about investing in somewhere like China is the question of fraud and corruption and what have you. And I've been travelling to China before there was a stock market there, researching companies up there that were listed in Hong Kong. And care for longer than that. So it's sort of, for me, about 28 years, care for longer. And the only way we've really found to answer that is that in all of that time and all the investments we've made there, which are many over the years, is that can really only think about one time where we were defrauded in the sense that the accounts that were presented to us were not genuine. Because in all of the research we do in all companies around the world, you're always looking for signs of people playing with the books. And there's some simple things that you can normally, test. I mean, if you haven't got a big accounting firm as your auditor, well, that's a bit of a sign. How did you come to market? There's a whole lot of Chinese companies that come to market using very questionable investment banks. But if they came to market using, Morgan Stanley or Goldman Sachs, not organisations that I think are the greatest in the world, but they will have done an awful lot of due diligence around the accounting and around the factual statements that are being made. So you get by. And we've certainly lost money on plenty of Chinese stocks, don't get me wrong, but that was our poor judgment. That wasn't a problem with the accounts or whatever. Kira, I don't know if you'd like to.
My question is about kinds of interest rates which were simply not available in the banks. If you go back a couple of decades, it seems to me that the kind of good returns on good stocks has never been better.
We wouldn't discourage anyone from taking those sort of yields. What you want to be very clear about is looking at the recent or the last 10, 15 years, what led to those types of profits and how sustainable are they? And if you're quite clear that they're sustainable at around these levels, or that the company will be able to sustain its dividend, then certainly we have no complaint about you using those investments. We think that would be perfectly sensible.
Investing in India, if Britain here.
So I'll do India. We have a few percent invested in India in the international fund, and obviously the Asia fund, I think, is more around 18% or so. It is one of the great macroeconomic top-down stories. I mean, in India, investing in basic infrastructure of power generation, roads, ports, it's where China was 15 years ago. Every time you do that, you bring people into the modern economy. Their national ID system, which is biometric, which I think we may have hit, we've hit 1 billion people now. So 10 fingerprints and iris scan on both eyes. And, people in the West always go, oh, why would you want that? It's Big Brother. Well, we all have identification. You don't appreciate how important it is to be able to identify yourself. So you can now walk into a bank. In 2 minutes, you can open a bank account. I bet you can't do that here. All you need to know is your 12-digit number, and they do a biometric check. So all the time, people are being brought into the modern economy. The place has struggled in recent years, higher interest rates, imbalances, all these things are starting to come good. Our investments there tend to be in assets or companies that have been held back by higher interest rates, banks, infrastructure companies, toll roads, or power generation businesses where high interest rates have impacted their valuation. But unfortunately, the only downside to India is it's one market where, it's gone off the boil a bit, but, locals were very enthusiastic about their own market, so it's not the most unloved of places because the locals are pretty keen. That's gone a bit soft in the last year, but still valuations of things like consumer businesses there remain reasonably high.
So on the issue of a Brexit, I'd probably point out the one thing that we're probably the most confident about is if the UK does decide to leave the euro, the UK stock market and UK stocks probably will, I'm quite sure they will fall in the short term, simply because of the fact that markets hate uncertainty, and this will be viewed as a nice source of uncertainty. But then bringing it back to the actual real economic impacts. So you can look at all the data, and the data will show that there is a economic benefit to the UK of remaining in the EU. You can see that through foreign direct investment from Europe into the UK, the amount of cross-border trade between European and UK companies. So from that theoretical point of view, if the UK leaves, it will have an impact on the economy. But then precisely measuring that is the difficult part, because there's a whole bunch of common sense reasons why Europeans do like to invest in the UK, why the UK does attract FDI, and why European companies trade with UK companies that have nothing to do with their membership of the EU, and that's not going to disappear. And in addition, we have to see what the eventual negotiations between the UK and the Europe will be post an exit. So that's how we would address it. The other thing, I guess the other thing to mention is, from the political standpoint, it's a little uncomfortable because you're always looking for these precedents, and the precedent of a major EU country leaving the mechanism, does leave it for the other countries to see how that goes. And we must acknowledge that politics in Europe has gotten a little more radical, certainly post the GFC, with a lot of these more marginal parties getting far more of the votes.
Just a little more on Brexit. I mean, one of the problems is that it's just an emotional plea that's been made, because if you look at the trading conditions under which places like Iceland and Norway trade, they still have to make a contribution to the central budget, but they have no say in how that budget is spent. So for Britain to have continuing access to Europe is an open question. And so all these emotional issues that are being thrown around are really discouraging to me, because they're so far off the mark. Overall, the country will lose considerable momentum from leaving, in my view, if it happens. It's just a nonsense about the budget. I mean, net, they're supplying about 8 billion. Well, that's what they probably blow off in a couple of these wars in various parts of the world in half a year. Why would we not think BHP is neglected and interesting? Simply because you need to understand, as I hinted earlier when it was suggested that there were nice 8% yielders around, what led to that? What were the antecedents that created that big run-up in the bull market in BHP and the subsequent sell-off? And the problem is that with the price of ore being so cheap, we had an undersupply for a long while. There was then a massive spend in building up capacity, both in this country, Brazil, you name it. Even the Swedes were starting to move iron ore across the northern channel. There was a huge response, and that is the point you need to understand, that these responses for suppressed prices can be gigantic and multi-year in their duration. So we're simply reaping the consequences of massive overinvestment. So will it be a good investment or not? I'd not like to make a judgment, but what I would like to say is understand the antecedents. And our view is that there's not going to be much shortage of iron ore for a long time. We're more optimistic on oil simply because most people are focused on the current oversupply, but in fact, demand is growing. Miles traveled in the US are up now 5.8% on a year ago. So the cheap petroleum products induce greater consumption, just like we talked about earlier with ore. So we think the whole hydrocarbon complex could be quite prospective, and we've been buying a couple of stocks there. So in terms of BHP, understand market responses that are long-term, because that will give you the hint of whether it's an interesting investment or not.
I enjoyed those presentations. Thank
The MSCI stands for Morgan Stanley Capital International. The alternatives are things like the FT index. And what we're simply doing is using this as a benchmark against which we're trying to assess whether we're keeping up with the field or doing better than the field. It's not as interesting as it could be because, as we suggest, it's hugely biased towards the US with 52% weighting, whereas the US has about 18% share of world GDP, world output. The US is now a relatively smaller part than it was 30 years ago. But it's nevertheless a measure. Perhaps one could measure it against term deposits, one's performance against term deposits, or any of these other measures. Because indeed, we do run cash and shorts to try and remove volatility and downside risk. So when we look at our performance over the last 10 years, we're giving you about 10.4%. That is on a portfolio that has been invested to the extent of about 75% of the total. So it's really quite a good return on a risk-adjusted basis. It's a very nice return on a return basis. But it's just the conventions of this industry, and you can accept it as for what it is. It's just a benchmark. What we're more concerned about is, are you able to have more money next year than this year? That's what our main focus is.
Referring to that, if you look at your quarterly report, the one fund manager who's dramatically outperformed this year is Japan. And I was wondering, what's Scott Gilchrist drinking? And when's he going to share it with the rest of you?
Yes, Scott's done a good job, but he doesn't drink enough in my view.
About consumption of oil, do you have a view on what's going to happen to production levels in the short term?
Well, that's integral to the whole storyline because what we're seeing is US liquids production's now dropped. I think it's right on the borderline of 9 million barrels a day. What we're seeing elsewhere is, of course, a step up in the Iranian production, what have you. But the world has never had such a small margin of output versus potential capacity near term. Libya looks like it's coming back. But these are tiny amounts. The world is consuming 92, 93 million barrels a day. This is of oil. And we're talking about a margin of extra supply of a couple of million barrels a day. So it can change quite quickly. And as we saw, there was a bit of a fright the other day. The Kuwaitis closed, so that was going to take out 1 million barrels a day plus. And so that's what we're focusing on. And just keep looking at the use of oil. It's growing. And that's our great concern, and has been when the oil price was well over 130. It was all about where's the next supply going to come from. The majors, over the last, over the last 15 years, they've spent over $120 trillion, and their aggregate output is no higher now than it was then. That's the problem. When you buy these stocks, and we've been, as I say, we bought a couple, finding oil companies that are adding greater reserves than they're depleting, so they've actually got an increment to their reserve base, is very rare.
Just out of interest, looking at one of the charts that you showed earlier, there was talk about the third item of being a contrarian and looking for value. How hard is it to stay contrarian and in the value bucket as an organisation over the long term? And to what extent do you stay undervalued and unloved from a portfolio perspective?
I think that it is deep in the core of the DNA of the organisation, but in the most, the experienced, the members of the investment team who have the most years' experience. I mean, it is just what we are wired to look for now after many years of doing it. So staying there, I don't think, is hard. In the world we're in, though, there aren't many free kicks. So in the past, you may have just said, this thing's being sold off hard, and you would be buying it and you would get a rebound. But, as with this, I think, there's much greater need to understand, and, we've always tried to understand the future of a business we're buying and looked for why it's going to get better. But there are very few, free kicks out there. So if you're not right about iron ore coming back, you will sit in a BHP for a very long time and not make money. And that's what is more difficult today than maybe, in the earlier periods of sort of the great bull markets we've been through. Okay, so we'll just have one more question, and then we can. There's plenty of members of the investment team here and investor services. So after this question, please join us for a drink out the back. Yes.
Hi. It's my understanding that the local banks have stopped now lending to overseas buyers of local residential. Is that also your understanding? And if so, how significant a portion of the total funding was that anyhow? And what impact might this decision have?
Yeah. So, I mean, I'm only aware of from, what I saw in the Fin Review yesterday that's the case, that at least I think it was Westpac. And here's the problem: is you can quantify these things all you like, but if you take out a small percentage of buyers, they may only be 2 or 3% of the buyers of those apartments, but you can completely change the dynamics of that market. So will that do it? I don't know. There's a huge wave of money that is coming out of China still to invest. And, this is not just happening in Sydney and Brisbane and Melbourne, and it's in Vancouver, it's in New York, it's in Tokyo, it's everywhere. So will that little change make a difference? It could be the straw that breaks the camel's back, or it may just be, nothing, not even a speed bump. Hard to tell. Right. Well, anyway, thank you very much. Please join us for a drink.